Well, Atlantic was established in 2007 as a dedicated fixed income asset management company and aims to provide income solutions to its clients through either unit trust funds or segregated mandates. Arno Lawrentz, CIO at Atlantic Asset Management, joins us from our Cape Town studios to share his insight on global debt markets. Arno, thanks very much. I hope that you're not going to depress us too much this evening. Kevin's already done quite a good job of that.
I'm afraid that tonight is not going to be a good news story again. There's still a long way to go, unfortunately, and some of the bigger problems that we still have to face. So it probably means that I'm going to have to keep coming back for a long time yet before the good news really does flow. So we'll leave it at the bad news story continues.
Well, how depressed are we going to get this evening? How depressed are we going to get this evening?
I don't think too much, because it's very much a continuation of the theme that we've seen over the last while. Just the country changes. So we're sort of taking a tour through Europe, and one day when we finished Europe, then we'll probably move on to another part of the world like Japan or something like that. So the news is the same, or the underlying story is the same. The country changes. We're focusing on Spain now, so perhaps we should rather talk about cheap Spanish property or something like that.
Arno, have you got any appetite for European instruments, or do you need some catalyst, some resolution? In other words, what makes you look back at European assets, I'm talking about fixed interest instruments, and say, well, at these sorts of yields, I'm going to make the contrarian trade and I'm actually going to buy these instruments?
Yeah, that's such a tough question as an investor rather than as a speculator. So I recall sort of probably in around about August last year, there was one particular client who actually asked us the question, surely it's time to buy Greek bonds now, because they'd already moved up substantially. Greek bond yields at the time, 10-year bond yields, I think were trading something like close to 40%. And we said, well, there's still a lot of uncertainty. We don't know the extent of the losses that private sector involvement is going to take. And we said, hang on. You know, and the extent of the losses that ultimately that we see till today, purely on the bonds alone, let's not forget about potential currency losses in time to come. The magnitude just flabbergasted all investors and speculators for that matter as well. So to try and say now as an investor, where an investor is taking a longer term horizon, this is not about trying to buy something so that you can sell it again in a week's time or something like that. It is really a situation at this stage where no investor should be taking a view, because what you're really taking a view on ultimately is on the vacillations of politicians. And we know that there is absolutely no way that you can think about a 12-month horizon that they're even thinking about at this stage. So investing, no.
Arno, you say same news, different day, and that we're taking a tour through Europe. But the reality here is that we are building in magnitude when it comes to the size of the problem. And we look at these, right now, the Italian bond yields kicking out as well. We are in for tougher times. So we're not talking about Greece here. We're talking about Spain. Obviously, we've seen the bailout and that news flow. But Italy is a sizable concern. This could be the implosion of the Eurozone.
Absolutely, Bronwyn. I mean, the Italian bond market is the third largest bond market in the world after the US and Japan. So without a doubt, what you're looking at is something much larger than what we've dealt with at the moment. And I agree with you completely, which is that the Italian story is the real story that we have to deal with, because if the Italian wall breaks, then all hell breaks loose within Europe, and almost certainly the Eurozone is no more. And in fact, one could already at this particular point in time say that the solutions that the politicians have come up with thus far have done nothing to stem the tide. So they've spent an inordinate amount of time and money trying to rescue Greece. It didn't work. And now the focus shifted to Spain. Now they've spent, let's call it 100 billion euros, or prepared to spend 100 billion euros of money which we don't even know where it's going to come from, to perhaps try and stem the tide there. The market's looking through it. And this is the law of diminishing returns, in the sense of that these rescue packages, the market is slowly but surely coming to the realization that there is no short-term solution. It doesn't matter what the politicians say or do. There is pain either way. And this is the trade that we've been saying, is that ultimately, in the long term, there is no easy way out of this solution. Somebody has to take a serious amount of pain, and someone has to pay. Most likely it will be Germany. Now, here's the final point on this, is that whether it's Spain, Portugal, Ireland, Italy, whatever the case may be, at this particular point in time, we do not know what the end game is. And we can't even speculate about what that end game is going to be at this stage. And that's exactly the reason why I say, if you don't know what the end game is, with Italy being the final nail in the coffin, if one wants to put it like that, you cannot make a coherent investment strategy out of that. And that's where we stand at the moment.
Arno, how do you feel about an end game being the issuance of euro bonds? Do you think, obviously, a classic euro bond would see Germany really losing out? From your perspective, would that solve the problem? In terms of, when I say solve the problem, it doesn't result in economic growth, but would it settle down the market uncertainty?
Yes, I do actually think that that is the ultimate solution here. As I said, someone has to pay. So the issue of Eurobonds, for those viewers who don't yet understand, is effectively one single borrowing point or one single borrowing yield. So no longer do you have Greece issuing any bonds, no longer do you have Spain issuing bonds and Italy issuing their own bonds, where each sovereign government is now the underlying credit risk. There is then one single credit risk, which is the Eurozone in totality. It means that all of those weaker Eurozone countries, in terms of credit risk, i.e. Spain, Portugal, Italy, and so forth, and Greece, versus the stronger, so there perhaps only two, France and Germany. The difference there is the weaker ones get lower borrowing rates, whereas the stronger ones now get higher rates. And they are the ones who effectively subsidize the weaker components of the Eurozone as far as borrowing costs are concerned. What it does do is provide one single entry, and it allows, in my mind, a much better and cleaner and transparent access to funding for all of those countries. The critical aspect is to ask why not yet. And the answer there is because Germany has to pay. And what do we mean by Germany? It's the German taxpayer. Now, why is it a problem? Because A, it's political, but I think there is a precedent for this, in a sense of Germany paying, in the sense of not as reparations for the Second World War and so forth, but more in a case of the reunification of Germany. So there was East Germany, West Germany. To this day, all Germans still pay a line item on their tax return for the reunification of East Germany with West Germany. Now, in my mind, I think it's a political hot potato, but ultimately Angela Merkel, or whoever may follow her, has to sell this concept of the Eurozone to the German taxpayers. And they will have to have a line item which says subsidy for Eurozone brotherhood, or sisterhood for that matter. If they can get that down the line, then I think we will be on the road to healing the Eurozone and healing the crisis and allowing us to get to an end game.
All right, well, let's move from healing the Eurozone to the US. Andrew Cantor, Future Growth, often says he wouldn't touch US bonds with a barge pole. Would you be buying US bonds right now, Arno?
I wouldn't be at this particular point in time. In my mind, I think you only want to buy US Treasury bonds, Japanese Treasury bonds, German Treasury bonds as a safe haven. They're not an investment at this particular point in time. You look at inflation rates, the yields that you're getting are negative real yields, so you're not buying it for a long term here. You are only going to be buying US bonds for a safe haven. So I would agree with Andrew in that respect. Is that any of those bonds, you're buying them for a safe haven, hoping to make some sort of capital gain, hoping to protect your capital. Iraj Abedian, that was on earlier, who's on our investment committee, I agreed with what he said there, is that there are times when you really just want to have your capital back rather than having a return on capital. That's all that these developed markets bonds offer you at this stage, is a return of your capital if you ultimately hold it to maturity. But you're not going to be earning a real yield. So no, as an investment, definitely not.
Oh no, Iraj earlier on the show was saying that he feels interest rates in South Africa are too high. When you look at long-dated government bond yields. Do you think it's fair value? Do you think it's attractive for foreign investors? Where would you put long-dated instruments in South Africa?
Yeah, look, I mean, if one looks at the inflows that we've seen over the last 2 years, there's no doubt in anyone's mind, or there should be no doubt, that they are immensely attractive from a yield perspective relative to what you can achieve in yields in the developed markets, the Eurozone, US, Japan, and so forth. So make no mistake, they're exceptionally attractive for income investors in the rest of in the developed world. From our perspective, we look at it and we say, well, you know, there's a fair balance of risk here. There are some positive factors, notably the fact that we included in the World Government Bond Index, the Citigroup Index, that will introduce further and sustained inflows. But on a pure valuation basis, one looks at where inflation is, 6-odd%, you add on a risk premium over and above that. And I don't see South African government bonds as being excessively cheap. There are still a huge degree of uncertainties relating to our issuance, where we're intending to get to. Some inflation risks, but you will know that over the course of this past year so far, I've been at pains to say I think the market's pessimistic about inflation, and as it is, we're busy topping out there at the moment. So there are a lot of push and pull.
I've got one more question,
Arno.
Arno.
We're in a bit of a no man's land at this stage.
Because we're running out of time, I've got one more question. This is a very easy one for you. Where's the rand going? We're at 8.45 on dollar rand right now.
Yes, always the easy question that I've got to answer about the currency. I really think that there is sufficient reason to be optimistic about sustained capital inflows into the country. Yes, I understand that there are some issues around policy and so forth. They tend to be very short-lived. We are going into the strike season as well, so there's going to be a lot of noise. Potentially that can be an issue. But also the risk-on, risk-off type scenario. I think the biggest issue at this stage is, for the rand, is are there going to be capital inflows? The answer is yes. Low rates in the developed world. Our rates are going to stay probably very much similar to what they are at the moment. So it's very attractive for foreigners. Yes, ebb and flow, but I still think there's going to be sufficient capital coming in with
so a stronger rand. You're saying a stronger rand from these levels.
Sort of comfortable zone. Yeah.